All right, let's get back to tech and the strength that we have been seeing. I mean, the NDX at new highs. We just talked about Marvell at new highs, many of the Mag 7 at new highs. Howard Chan is with us, founder, CEO at Curve Investment Management. Thank you for being with us. How do you feel when you see all these new highs related to tech?
When everybody is very excited, we get a little scared, actually. We think, right now, the market is very sanguine about where most of the tech stocks are going. We think we're actually starting to prepare for 2025, early 2025, for potential correction, where maybe sometimes exuberance overshoots a bit.
I was listening. Yeah, I was going to say, there are some people who think that what you're saying, that maybe they won't even put some of the Mag 7 in their top 5.
Yes, I think this is a difficult choice for a lot of advisors, right? I think in late July, people were talking about whether the AI valuation was too high, and maybe there's a rotation into small cap. And if they did that, it would have been a very expensive switch, because there's probably a big capital gains bill waiting for them. And then when the market turned since November, they would have missed out on another rally, which would probably made their portfolio underperform the market. So for us, I think fundamentally, we think that the tech sector is very strong. You can see from the earnings that these companies are having higher earnings, so the valuation in some ways are justified. We separate the tech sectors between the software layer and the infrastructure layer, and we continue to think that the chip makers, the cloud providers, will continue to have very good earnings, largely because in this year's earnings call, they have already allocated capital to spend in these particular sectors.
Yeah, understood. So, the question was whether or not capex spending is slowing, right? Which people thought the AI boom, and then maybe it's pulling back a little bit. Did we see the big part of it already? And then there are other people who are like, we're in the first inning, and super excited about the new year. How do you propose people still make money on tech or AI in particular?
Yeah, so we at our firm, we have a strategy, KQQQ, an ETF, where we try to navigate these moments of exuberance and corrections. We are still pretty sanguine on the infrastructure part of the AI run, and I actually agree with many that we're still in the early earnings, and the reasons is a few things. The capital expenditure will continue to come in. The ability to have compute power and cloud computing is necessary to train these models. But we're actually only in the first earning because most of these applications have been on a B2B basis, and we haven't really seen it filtered out to B2C. And as well as many of the non-tech companies who have to figure out a way to use these applications in their businesses. So we think those will be particularly strong. But I think what we're concerned about is how do these tech companies, the software layers, actually monetize these models? And I think that the market is maybe overhyping that expectation a little bit. We saw some green shoots from how Facebook is using it to energize their advertising business, but it's a little bit less clear in terms of the other companies, how they're going to actually monetize these models.
When we think about companies that have monetized AI, I remember being at a conference and the gentleman actually said which ones. It was only like one or two that actually figured out how to monetize AI, in that person's opinion. Are companies monetizing AI yet? If so, which ones?
I don't think so. I think largely the ones that have businesses that are digital, so advertisement, and that's why we think that Facebook did quite well, because they've started using their models to try to target better ads for their audiences. But for other businesses like even Apple or consumer type businesses, I think they're still trying to figure out, because they're the way that they're actually offering AI is that multiple models on their phones for consumers. So they haven't quite yet figured out how they will, monetize it. So that's why we think, even though fundamentals is very strong, I think the market may be disappointed, and therefore valuation may have cycles of corrections in 2025, and investors ought to be able to navigate those cycles of corrections without actually moving out of tech, because we think we're still in the early innings.
When I think about the B2B versus B2C, you talk about that we're starting to move from B2B to B2C. That also opens up other opportunities for investment, right?
Right. And you've seen this a little bit with some of the chip makers who are making chips not just to help these LMMs being trained, but they're actually being incorporated in consumer technology products. So I think that is actually a frontier, and that's why we think it's still in the early innings. And that is potentially a way for companies to monetize the physical capabilities into consumer products. That would be quite exciting.
What do you think about some of the names that have been in the news this week? I mean, Nvidia is always in the news. We had Broadcom, we have Marvell at new highs. We were talking about Taiwan Semi today. When you think of the different names, are some standouts to you that you would consider investing in, or you like to watch, for example?
We still think that Nvidia is a very strong player and maybe a very dominant player in the infrastructure space. But I have to mention that they had a pretty good earning this past quarter, but the market was disappointed. And that's what we're worried about, because we think the expectations may be too high. And again, if you look at a similar companies within the same sector, right? Qualcomm, Broadcom, these infrastructure, even Oracle itself that provides the infrastructure around AQ, we think those will be very strong names going to 2025, because the large companies like Google and Facebook that have to train these models, they have to expend a capital, the software, the infrastructure to train the models.
The rate environment is a big part of your recipe. I saw today that the Fed is likely pricing in 3 rate cuts next year. And of course we'll get one most likely next week. Is that the camp you're in?
No, I think you bring up a really good point. I do think some of these hardware companies will be insulated because the capital expenditure has been budgeted. But you're right. We actually think, given uncertainty about fiscal policy, but also where inflation is, we think the rate cap will be a little bit more muted than what the market is pricing in. And obviously, a lot of growth stock is very sensitive to the discount rate in terms of valuation. So that is something we're definitely watch out for. But our base case is that we will not get as many rate cuts as the market is pricing in right now.
And when I look up KQQQ, which is one of the ones that you like, you just said it sort of handles some of the volatility too. A final thought there on that.
Yeah, so we designed the strategy to have asymmetric upside and downside mitigation. And this is, we accept the fact that in the technology sectors, we're going to have moments of exuberance, which we believe we're in now, and then most moments of correction when people wake up and reassess their expectations. So when the market is going up right now, we weight our names by momentum. We're overweighting a lot of the infrastructure names, as I've mentioned. And then when the market corrects, we actually take advantage of the fact that inflation wall comes up, and then we write cover calls and we generate income to cushion the downside without allocating out of technology. So we don't have to have that capital gains bill. And then when the market ultimately reverts back to a cycle of exuberance, we take off the cover call, and then we again turn on the momentum weighting on specific names.
Howard Chan, Curve Investment Management, thank you for joining us. Really appreciate it. Thanks.